Welcome to Target Professional Consult. Please subscribe to the YouTube channel if you have not done that. Then like and share the video to your friends. Good. Today I'm going to look at the teaching section of one of the standards called IAS 23, borrowing cost. So IAS 23, borrowing cost. Good. That is the Now let's look at the detailed issue. IAS 23 prescribe the correct treatment of the borrowing cost. So that is the objective of this standard. We'll look at the scope in the subsequent illustrations. So now we know the objective is to prescribe what? The correct accounting treatment of borrowing cost. Now let's look at some definitions in the standard. So the terms, basically there are not many. The terms that we are going to meet, they are two. So we are going to look at borrowing cost itself. So borrowing costs as the first term. Then the second term, we are going to look at for what you call qualifying assets. Qualifying assets. Good. So these are the two terms you are going to meet. Now let's try and then explain them here. Now, what is borrowing cost? Borrowing cost. So borrowing cost refers to interest and other costs incurred by an entity in connection with the borrowing of funds. So if you go and secure funds, what are the costs that you are going to incur? That is the borrowing cost. Here, we should take note that it does not include only interest. Here we are talking about interests and other costs. Now let's see. So we said that the borrowing cost is made up of what? The interest and what? And other costs. Good. Other costs. We can give example of other costs. Processing fee, admin charges. Good. So all these form part of the borrowing cost. So that is it. We'll look at the breakdown. I think after the explanation of the qualifying asset, we look at the breakdown of borrowing cost or the IAS 23, the coverage or the scope. Good. That gives us examples of borrowing cost. Now let's go to qualifying asset. Qualifying asset. Asset that's what qualifies. So when you talk about qualifying assets, you're going to use it in these standards. Qualifying assets is an asset that necessarily takes a substantial time of period to get ready for its intended use or sale. So any asset that takes time before it will be ready for its intended purpose, that is a qualifying asset, not ready-made asset. No, asset that will take time. So it being construction, acquisition, modification, manufacturing, all of them qualify to be qualifying assets. So let me explain the qualifying asset. So qualifying assets, simple, it's an asset that necessary that necessary takes some time, takes a substantial period of time. Period of what? Of time. Period of time. Good. To get ready for its intended purpose. Intended purpose. And the purpose can be its intended use or sale. Good. Because sometimes you are buying that asset for sale or for use. These are the two reasons. Or even for rental. Also qualify to be what? A qualifying asset. The bottom line is this. Any asset that takes time before to be ready, qualify to be what? Qualifying asset. So any asset that takes time. So let's give an example of qualifying assets. You can talk about inventory, manufacturing inventory, building, construction of building. But if you go and acquire a completed building, it's not a qualifying asset. It's something that you will take time. Okay, today I'm buying a land, tomorrow I'll build on it. Take time before my building be ready. Good. That's what a qualifying asset. Good. So basically, we will look at the examples of qualifying assets and the examples of borrowing costs right after this. So now let's look at them. Good. Now I'm going to look at examples of these two examples. Now the specific examples of borrowing costs are interest on loan, interest on bank overdrafts, short-term and long-term loans. So that is a specific example one, interest on what? Loan. So let's see. First, interest on loan. Yeah, whether short-term, medium, and overdrafts, all of them, any interest you are paying on this facility qualify to be what? A borrowing cost. Then finance charges in respect of leases that are recognized in accordance with IFRS 16. So another example is finance charges on leases. So let's look at the examples of borrowing costs. Let me do it nicely. Example one, we said that is interest on loans. So here, any loan at all, it can be overdraft. Overdraft, that's the OD. Good. So overdraft can also be short-term or long-term loans. Two, finance charges on leases. Finance charges. So finance charges on leases that are recognized under what? IFRS 16. How we get it? Good. So all these are examples of what? Borrowing costs. So borrowing costs are interest and any other cost you incur when you secure what? Finance or in connection with what? The borrowing of funds. In connection with the borrowing of funds. Now let's look at the last example as stated in the paragraph 6 of the standard. Now the last example is the exchange difference arising from foreign currency borrowings. So exchange difference. So exchange difference arising from where? Foreign borrowings or foreign currency borrowings. So if you go and then take funds from, let's say, the other country, so you go, let's say, $2,000, and then at the time that you are going to pay, let's assume that your local currency that is in the city, maybe it's just 5 Ghana cedi per dollar. So the $2,000 would be what? 10,000 Ghana cedis. So 10,000 cedis. So now you've taken 10,000 cedis, which is equivalent to $2,000. A time will come, maybe for 3 years, in the third year, but then the dollar to cedi rate might be moving or it might change. So to change, let's assume that in 3 years' time, the dollar will be pegged at 6 Ghana cedis. So if it's 6 Ghana cedis, $2,000 will be what? Now you have to get and pay 12,000 Ghana cedis. So now you'll be paying 12,000 cedis. So therefore, there's exchange difference of what? 2,000 Ghana cedis. This 2,000 qualify to be what? To be treated as what? Borrowing cost. Good. We can also talk about administrative charges. Administrative what? Charges. Yes. All of them. Good. Now let's look at the examples of qualifying assets. These are the examples of borrowing costs. But for the purpose of our study, for borrowing costs specifically, we are going to consider the interest. So most of the examination questions, the interest is what you are going to consider. But you meet the finance charges on leases on its own. When you're doing IFRS 16, yes, get that video and then look through. Good, you made it there. Then exchange differences or foreign exchange transaction, IAS 21. You can also see that one also there. Good. Now let's go to the specific examples of what? Qualifying assets. Now it means that these are the items that the standard deals or the standard talks about. Good. Now, let's look out for the examples of qualifying assets. Examples of what? Qualifying assets. So qualifying assets. Qualifying assets. Assets that qualify. So they are inventories. So one, inventories. That's manufacturing inventories. So inventories. Two, manufacturing plants. Manufacturing plants. Then three, power generation facilities. So power generation facilities. So facilities. Good. Then talk about intangible assets. Yes, which is IAS 38, right? Good. So intangible assets. Intangible assets. Intangible assets. Investment property. Investment property. Investment property. Then finally, bear plans. Good, bear plans. We've explained this under IAS 4016 and IAS 2. Especially we did that in IAS 16 PP. We explained bear plans. Then we add that. So these are examples of qualifying assets. Qualifying asset. Good. And you can also talk about the construction of buildings. In fact, any other assets that takes time before to be ready, that is the qualifying asset. Good. Good. Now let's move on. Now we are done with the basic definition. Now let's go to the main issue, the accounting treatment of borrowing cost. We said that the main borrowing cost that we're going to talk about is what? The interest expense. Now let's see. Now be with me and then let's go through together. And then you will be fine. Or everything be right. Good. So accounting treatment of borrowing costs. So accounting treatment of borrowing costs. Now there are two accounting treatments or general view of the treatment of the borrowing cost. We have what we call the benchmark treatment or the traditional treatment. Benchmark treatment or the traditional or the convention. Good. That's the benchmark treatment. Great. Then we have what we call the allowed or alternative treatment. So these are the two treatments. We are done. So now let's discuss each of them, the two treatments. First, benchmark or the traditional treatment of borrowing costs. In fact, that one is so straightforward. Traditionally, or before coming to being of IAS 23, all borrowing costs are expense. So here, the treatment is that all borrowing costs are expense. So, in fact, let me put it down here so you can see it clear. Let's come here. So, we're talking about the traditional treatment or benchmark treatment. All borrowing costs are what? Expense. So, expense in the P&L. And so this is the allowed treatment. So this is the benchmark treatment or the traditional treatment. So that means it must be expense, preferably in the finance cost. So that's the finance cost that we see in the financial statement. That is the, sorry, that's a short account. That is in the profit and loss. The finance cost that we see or the interest expense, that is the borrowing cost. Good, interest expense. We are done with the benchmark or the traditional treatment. Good. Now let's go to the allowed or the alternative treatment. The allowed or the alternative treatment, in fact, we can refer to as well the IAS 23 treatment. Now, before IAS 23 came into being, the old treatment of borrowing costs, in fact, it was expense in the P&L. That's the benchmark. Know that the IAS 23 have gone through several stages. IAS 23, the exposure draft was issued in November 1982. So in 82, where they issue the exposure draft. So do that before coming to being of this standard, we are just expensing our borrowing costs. We are done. Then March 1984, IAS issued the IAS 23. That's the borrowing cost. So the borrowing cost came into being in what? 1984. You don't know all these years. In fact, after IAS 23 have gone through several amendments or changes. And then the major one was 2007, March 2007. There was an update of IAS 23, which requires the capitalization of what? Borrowing cost. So which gives an alternative treatment or an allowed treatment of what? The traditional. So that is the IAS 23 treatment. So you can also call it what? IAS 23 treatment. So what's the treatment? Now let's look at the treatment. It is the main central focus. Don't forget that the accounting treatment, we can also term it as what? Recognition. How do you recognize the borrowing cost? Traditional recognition and alternative recognition. The traditional recognition, all borrowing costs must be what? Expense. Then the allowed or alternative version, that's according to IAS 23, the borrowing cost will be what? Capitalized. Good. So that is it. Now let's see. Let's look at the allowed or the alternative treatment. So IAS 23 is saying that some, let me use capital letters, some of the borrowing costs eligible for capitalization must be capitalized. Good. So borrowing costs eligible for capitalization must be capitalized. That is the what IAS 23 states, and that is the alternative or the allowed treatment. Good. So some of the borrowing costs, or we can say it at what, or we can draft it like all eligible borrowing costs must be what? Capitalized. So some of the borrowing costs that are what? Eligible must be capitalized. That is it. Meanwhile, traditionally, all borrowing costs, whether you qualified or not, it must be capitalized. Then we are done. Good. So that is the treatment. Good. Now let's move on. So now we have now entered into IAS 23 territory. So now let's look at the capitalization of the borrowing cost. Good. There are three issues. Now the borrowing costs eligible for capitalization, they are the cost that is incurred directly, costs or borrowing cost that is incurred directly on the acquisition or construction or production of a qualifying asset. So they are the borrowing costs that you have what? Incurred. So now let's look at this. We have started the capitalization of the borrowing cost. Good. So capitalization, what are, where we say some of them are what? Those that qualify. So you're going to define the proportion of the qualified. Then we are done. Good. So here we are saying that the borrowing costs that are directly, now we know borrowing costs, which refers to the interest or the finance charges, interest or the finance charges. Good. or the interest or the other costs. So borrowing costs eligible for capitalization. That will be the heading. Borrowing costs eligible. Good. Eligible for capitalization. Good. Good. So eligible for capitalization. Now here, these are the borrowing costs that are directly. So borrowing costs that are what? Directly attributable to acquisition, construction, or production of what? Qualifying assets. So borrowing costs, no shortcuts in exams. That are what? Directly attributable to the acquisition. I like the terms. There are three here. Acquisition, good. Acquisition or construction. Construction or production of qualifying assets. That's not what qualifying assets. Now we know what a qualifying asset is. So qualifying assets. Qualifying asset. Good. So that's the borrowing cost eligible for capitalization. That's the only borrowing cost that must be capitalized. So here we are saying that the borrowing costs that are eligible for capitalization, you must capitalize them. All borrowing costs that are eligible for capitalization must be capitalized. But in the benchmark, it's not like that. In the benchmark, whether it's eligible or it's not eligible, we are expensing it. That's the benchmark. Or that's the benchmark treatment or the traditional treatment. Good. So now we are done. Now here, these are the costs that would be what would have been avoided if the acquisition of these qualifying assets have not been made, or the expenditure on this qualifying asset have not been made. So here it must be directly attributable, incremental or incidental to that of the qualifying asset. So we are not talking about the cost that you are imagining. Okay, you had a soft loan, you didn't pay any interest. It's okay. If I should have contracted this facility in the open market, I'll pay 10%. So let me capitalize 10%. No, it must be directly attributable. Directly. Good. Now let's look at the few stages in the capitalization of the borrowing cost. Good. So that is the three items. Now let's look at some few issues. When do you start the capitalization? You'll call it commencement of the capitalization. And when do you suspend? Temporary. And then when do you cease capitalizing the borrowing cost? So that's the three issues that we are going to look at for. And then we start the main game. Good. Please, this section is the tuition section. So we normally explain the main issues and then we back it with what? With illustration. That's the question solving stage. So kindly join us at the question solving stage for us to go through various questions to explain the treatment of the borrowing cost. Good. Now we are going to look at the commencement of capitalization. When do you commence the capitalization? So no, there are three stages, right? You start, you suspend, and you stop. Have you seen? Start, pause, stop. Good. So that is the next game. There are three, but all of them have conditions. So we should get a condition satisfied, or we should be familiar with all the conditions. So we have start. When do you start? Capitalize the borrowing cost. When do you pause for some time? And when do you stop? Good. So start, pause, and stop. Yeah, that we have 9 terms for it. So let's look at the accounting terms that we are going to use. So we call it commencement of what? Borrowing cost. So commencement of borrowing cost. So that's the topic that I'm going to look out for. Commencement of the capitalization. So when do you start capitalizing the borrowing cost? Now, please, this condition, it must be part and part of you. It must be part and part of you. Please, these three conditions, in fact, there are three events or three conditions that must be taking place for capitalization of what? Borrowing cost to be started. So before you start commencing or before you start capitalizing the capitalization of the borrowing cost, the following three transactions must be taking place. So three items must be in position, or three conditions. The three conditions. So before you start capitalizing borrowing cost, in fact, what do you mean by capitalizing borrowing cost? It must be treated as what? As an asset. That's the meaning of the capitalization. You have to treat it as what? Capital expenditure. Let me explain that. You have to treat it as what? Capital expenditure. That's the meaning of the capitalization. It must be capitalized. So you add to the cost of the asset. You add it to what? The cost of the asset. So let's assume that I took a loan of 100,000 for this to construct office building. And then the interest that I paid on this facility amounted to 25,000 cedis. So the interest is 25,000. So if asked me to calculate the cost of the building, I say, okay, loan amount, that's 100,000. The interest, which is eligible for capitalization, 25,000. So therefore, the cost of the asset becomes 125,000. Traditionally, the cost of the assets, the cost of the asset will still remain at 100,000. Then I have to expend this. But because we are going by the IAS 23, that's the borrowing cost, we have to what? Capitalize these 25, meaning add it to the cost of the asset. Because I use 100,000 to build office premises, and then I incur borrowing cost of 25,000, so the it must be what added. So that's what we mean by capitalize the borrowing cost. In the traditional, we just have to expense it. Good. So following the IAS 23, some of the borrowing costs are now treated as what? An asset. That is the bottom line. Meanwhile, in the old era, all the borrowing costs are expense, they are expense. Good. So that is it. Now let's go to the three conditions necessary for the commencement of the borrowing cost. Condition number one, expenditure on the assets is being incurred. So that's the first condition. So condition number one, so condition that must be there before start capitalizing the borrowing cost. Or as soon as these three conditions are there, start capitalizing the borrowing cost or commence the capitalization. Good. So expenditure. Right here, I want to bring it so that I can get some more space to write. So condition number 1, expenditure on the assets is being incurred. So it's been incurred. We are done. Then two, borrowing costs are being incurred. Borrowing costs are being incurred. Good. That is the second condition. Now the third condition, activities are in progress that are necessary to prepare the asset for its intended use or intended sale. So activities are in progress. So active work is in progress. So active work. Let me summarize that section. Make it active work is in progress. Good. So active work is in progress. Then start capitalizing the borrowing cost. So these are the three conditions. Now let's explain them one after the other. In fact, all the three conditions must be there at the same time. Together, they move together. Even if you satisfy the first two, the last one is not there. Do not commence the capitalization. Either you have to stop or pause. If the last two are there, the first one is not there, stop. So that is it. All the three must be there or must be satisfied at the same time. Now, expenditure on the assets is being incurred. Let's assume that you've made your mind to construct a building, but you start paying the contractors. You start incurring expenditure on the construction, maybe some time ahead. I called the contractor, they started working. I know them, so they can use their own funds to work for some time. We agreed that they should use their money to pre-finance the project. When you go to certain stage, we will refund or reimburse them at all the amount that they spend. So it means that if they started the construction in January, but I actually pay them expenditure, we incur them around February. We pay the bills around February, or we incur. The word is what? Incurred. The expenditure occurred, or the actual work, where the actual work started from, or where they asked us to bill us. Normally, with the construction, it will be after the work has been satisfied. So after the engineers come around to come and certify the work that we've done, billing have to start from there, or the expenditure has been occurred. That is the bottom line. Now, the issue is this. So the construction started January, but the work was satisfied February. So we've incurred cost in February. So borrowing cost must start from where? February, not January. Good. So that is it. Now, the next condition is that borrowing costs are being incurred. Yes, you have to pay interest or any other cost on the facility that you've taken. If it is interest-free loan or sister thank you loan, brother thank you loan, these loans, they don't have what? Borrowing cost. Most of them do not have borrowing cost. You're not going to pay any interest on this loan. You're not going to incur any other cost on this loan. Then there's no borrowing cost. Do not capitalize it. There's no borrowing cost. So actually you have to pay a finance cost or interest to whoever gave you that facility or that money or that funds. Good. That is it. The last one is very critical. which says that activities are in progress that are necessary to prepare the asset for its intended use or sale. So active work is in progress to make the asset what ready for its intended use. To make the asset ready for its intended use. So all what mean that construction is in progress. So where you've paused construction or where you've not started construction or where you stop construction, please do not capitalize the borrowing cost. Don't commence. Stop. Don't commence. Hold on. Where active work is not in progress, hold on. This section is very critical. So let's take note of that. And all these three conditions must be in place. All these three conditions. Great. All these three conditions must be together. Now we are down the commencement. So if all these three are in position, why not? Green light, go ahead. Start the commencement as soon as possible. So here, you commence it. What if the active work will take more than 3 years? So every year, you capitalize a portion of it. Every year, you capitalize what is incurred. Don't forget that. So the borrowing cost has been what? Incurred. So you capitalize a portion of the borrowing cost that you've incurred for that particular year. Oh, until construction is over, you are done. Now let's go to suspension of what? Borrowing costs. Sometimes you have to pause. So the term is what? Suspension of borrowing costs. Good. So we are going to look at these three items, then we are done. Then we are done for the day. Then we come again for the question solving stage. So let's go to the suspension of the borrowing costs. Suspension of borrowing costs. Suspension of what? Borrowing costs. So now we have commenced or started the borrowing cost. So this is the first item I've treated. I'm going to the second one. That is the suspension of what? Of the borrowing cost. The suspension of the borrowing cost. Good. Great. So suspension of borrowing costs. So suspension of the capitalization So when do you suspend the capitalization of the borrowing cost? Here we are saying that the borrowing cost must be suspended if active development or active work is interrupted for any extended period. Suspend the borrowing cost. So when active work is interrupted for any extended period, that is it. So yeah, the borrowing cost should be suspended for those periods. So when the active work is being interrupted. Good. Interrupted for the line word is what? Any extended period. Extended period. Good. Any extended period. Great. Any extended period. Great. For any extended periods. So, in fact, when the active work is being interrupted or is being paused or a temporal hold on. So being paused or temporal hold on. Good. Here, the reason for the suspension is not necessary for temporal delays. not necessary for temporary delays or for period when substantial technical or administrative work is being taken place. So here the suspension is due to what? Unplanned management activities. Unplanned. So the reason for the suspension must be unplanned. Good. Unplanned management activities or unplanned actions. Actions that are not in line with administrative works. So it means that temporary delays and administrative works or planned actions must move on. Now let's look at the examples of this. So here we have to make sure that before you suspend the borrowing cost, let the actions be as a result of what? Unplanned management activities such as what? Strike. No one planned for strike that my employees will go for strike for certain months. No. Shortage of what? Raw material. Maybe you are constructing your office building and it reach certain level and then shortage of what? Raw material like cement, iron rods, so which delay the construction for a period of let's say 2 months. Good. Here you have to what? Suspend the borrowing cost. So that is the example. Now, if the suspension or the delay or the temporal hold on or the interruption is as a result of planned work, as a result of what? Plan, management intentions, then like substantial technical work must be done. And those technical works we have to pause, or those technical we have to hold on with construction, or administrative work must take place, then those ones do not suspend because it's part of the planned activity. Good. So that is it. Now let's look at some few examples. So I'll cite some few examples here, then you tell me whether they should suspend or they should continue capitalizing. If it is planned and fall within the administrative work, then it must continue. Borrowing cost must be continued. Good. So basically, that is it. Great. Now, my first example will be this. Let's assume that we are constructing 20 rooms building. Might be a story building. And then right after the pillars, we pause for the pillars to get firm and dry. It took minimum of 3 months. Meanwhile, in that 3 month period, we are still paying the interest on the funds that we secured for the construction. So the question is, should we suspend the capitalization or we should continue? Let me repeat the question. We took 3 months to dry the pillars because after the casting of the concrete, we have to wait for it to get dry before we insert the bricks. Good. Or the blocks. Good. Now, those period, do we have to suspend the capitalization or we have to continue for that 3 month period? Good. Here you realize that these are technical work. It's part of the planned activity that after every casting of concrete, we have to allow it to settle down, get dried before we continue. So that is what technical work. And we have to go move on. So it's part of the planned activity. Good. Now let's look at this one too. Before we pay before we get our money, the engineers have to come to the site and inspect the work or certify the work done. During those periods, we have to pause the construction and allow them to move in freely to inspect where we have gotten to so that we can move it from there or we can demand for our money. So what do we do? Here, is it a planned work or is it unplanned work? This is also a planned work. So construction must move on or capitalization must move on. So you don't need to suspend the borrowing cost. But in a period like shortage of raw material, employee strike, all of these, you have to suspend the borrowing costs. Good. Now let's look at the cessation of the borrowing cost. So you've gone through the three stages: the commencement, suspension, and the last stage is for cessation. That's where you have to stop. What's the difference between the suspension and cessation of the borrowing cost? Good. So cessation of what? Of capitalization. Of cap. So where do you have to stop? So here we are saying that once the substantial activities or all the activities necessary to get the asset ready for its intended use or sale are complete. So when the activities are complete, once the substantial activities are completed or they are complete, we are done with the construction. As soon as you are done with the construction, then cease capitalizing the borrowing cost. Even though the borrowing cost, you may still incur borrowing cost because let's assume that you pick a facility for 3 years and construction took first 2 years able to finish. So 11 what? To 1 year. So 11 just a year borrowing cost. That year, do not capitalize it. What do? Expense it. Why? Because all the activity substantially to prepare the asset for its intended use or sale has been what? Completed. We are done. So cease the capitalization of the borrowing cost if the activity as well has been completed. Good. Now, what if the construction was in stages? What if the construction is in stages? So, or was in groups? So, like building school blocks for that of the government. So, block A, block E, block D, C, in fact, uh, any block or the groups. So realize that some of the stages or some of the groups you are done with the construction. Some of them still going on. So here the standard is saying that if the construction is being done in phases, so stop or cease the capitalization of the phase or the group or the block that you are done with it. And continuing the continuing ones, you are done with the cessation. Now let's look at the measurement. What is the value? Now if you look, we've gone through the recognition. Now the measurement, that's the borrowing cost itself. Good. Then that is the end of the game. The rest, you join us when you're solving the questions. Good. Good. Now let's go to the borrowing cost itself. The types of the borrowing cost. There are two types of borrowing cost. First, we have what you call specific borrowing. So specific borrowing, and we have general pool of funds. Let's look at the specific borrowing first. Now with this type of borrowing, it's where you contract fresh amount or fresh loans to construct a qualifying asset. You contract new facility to construct a qualifying asset. So yeah, I want to build the office complex. So I'll go in for a new facility to construct this office complex. Good. Now, what will be the calculation? How do you calculate the borrowing cost? Now let me bring the other one so that you get the difference now. So look at the treatment later. The other one we call it general pool of fund. So general pool of what? Of funds. Here you use what you call existing borrowings. You also call existing borrowing. That's the general pool of fund. Existing borrowings. That is the general pool of fund. Good. Here, maybe you borrowed some funds 3 years ago or in the previous periods. Some of the funds are still available, idle, and you need money and you need funds to construct a new qualifying asset. So you just use the existing funds that are available. So that's the general pool of fund. All of these have a different way of calculating what the borrowing cost. Now let's give the formula or the steps how to calculate them so that when we meet, we will look at the question solving. Kindly join us when you're solving questions on the standards and you'll be fine. Please, a quick reminder, if you have not subscribed, kindly do so before you finish the video or before you download the video. If you have downloaded the video, if not subscribed, kindly subscribe. Good. Now let's look at how to ascertain or calculate the borrowing cost if that type of borrowing is what? Specific. So under the specific, you get the borrowing cost, relax. Bring the interest that you are paying on the facility, interest so much. Less what? Investment income. This will give us what? Borrowing costs eligible for capitalization. Borrowing costs eligible for cap. So this is what you have to capitalize. Then you bring the cost of the asset. Cost of the asset, that's the loan amount. So much. Now you get what? Total cost of the asset. This one becomes what? Total cost of the asset. Or the carrying amount of the asset immediate or right after construction. Right after what? Construction. That becomes the carrying amount of the asset. The carrying amount of the asset. Or the value of the asset after the capitalization. Good. Now let's cite an example. Or let me explain the investment income here. Investment income. Specific borrowing. We took 100,000 Ghana cedis to construct office premises. Just that you didn't use all the 100,000 one time. No, you are being careful. So you're giving the money to the contractor as and when work is being what satisfied by your engineers or by the team. So out of this, use 1 year. So January, 1st January, you took the money and you give the contractor 30,000. So left with how much? 70,000. Here we are going to assume that since you are in for business, you are going to invest the surplus funds. And when you invest the surplus funds until you need them, then you go and pick them up. Any investment income from where? Temporal investment of the surplus funds. So we call it temporal investment. Oh, sorry, that's why it's not coming. So in short, it is what? The investment income from where? Temporal investment of what? The surplus fund. So let's assume that June, you give the contractor 50,000 where the work was partly finished. And then December, you give the contractor December 31st, June 1st, you give the contractor the remaining 20,000 Ghana cedis. Good. So this was the payment terms. So you paid 31st January, on 1st June 50,000, and then 31st December 20,000. When the final work was completed, you signed the remaining amount to the contractor. So you realize that after making the first payment, you still have 70 Ghana's, so it's a 70,000 cedis available. So these funds became what? Idle. Then you have to what? Invest it. Any income that you had from that investment, in fact, we are lessening it because to offset some part of the interest, the remaining part of the interest is what? Is the borrowing cost eligible for capitalization. Good. So basically, that is the borrowing cost eligible for capitalization. Good. Now let's look at the general pool of fund, how you calculate the borrowing cost from that section too. So kindly take notes. Good. So join us at the question solving section to get all your questions answered or solved. So under the general pool of fund, here all what we have to do is to calculate what the capitalization rate first. So the first step is what? So step one, calculate what? The capitalization rate. We call it the WACC, weighted average cost of what? Capital. Because you are using the existing funds. So what is the cost of existing funds? What is the borrowing costs? The rate, the capitalization rate on the existing funds. That is the first step that we have to get it right. Then the second, you have to calculate the borrowing costs on the funds requested. So borrowing cost on what? On the funds requested. So as and when as and when you draw up some funds from the general pool, then the capitalization rate will apply on that amount, and then you are done. Basically, that is the end of the game. Now the question is, how do you calculate the capitalization rate? The formula is equal to the total interest. So let me do that one here. Formula is equal to total interest over the total capital or the debt. Total capital bracket the debt. That is the capitalization rate times 100, because we want to express as percentage. We are done. So that's the end of the IAS 23. The rest are the disclosure requirements. And they are, if you want to disclose, then tell us everything about the borrowing cost. One, the capitalization rate, the amount of the borrowing cost capitalized, and the amount of borrowing cost expensed, the current amount of the assets, and then we are done. So this is how far the good Lord will bring us for today's section. Thank you all for coming. Please subscribe if you have not done that, and you can join us when we are solving the questions. Great. Once again, this is Target Professional Consults. Good.